All right, let's just jump right in. If you're an income investor, I bet you've been feeling it. That creeping feeling that your portfolio just isn't pulling its weight anymore. Well, today we're going to tackle a huge problem head on, what I'm calling the dividend drought. We are going to break down why the old ways of finding income just aren't cutting it, and then we're going to uncover 3 specific areas where you might actually find some solid, sustainable yield heading into 2026.
So, where's all this anxiety coming from? Well, it comes down to this number, 1.3%. That's the dividend yield of the S&P 500 right now. And believe it or not, it's scraping the bottom of a 50-year low. I mean, for decades, investors could just count on good old blue chip stocks to give them a steady check. But today, that stream has slowed to a tiny trickle. Let's be real, a 1.3% yield, that's not a dividend. It's a rounding error. And this is where the problem really turns into a full-blown crisis. I mean, let's not sugarcoat it. If your portfolio is kicking off 1.3%, but the cost of everything, gas, food, you name it, is going up by 4% or even more, then your money is actively losing value. You're not just standing still. In real terms, you're actually going broke. This is that quiet killer that's hitting retirees and savers the absolute hardest. So how are we going to fix this? Well, here's the game plan. First, we're going to pull back the curtain on something called the high-yield mirage. Then we'll get constructive and build a new game plan based on 3 pillars. The companies literally powering the AI revolution, the market's so-called shadow banks, and the companies that are set to be tomorrow's dividend growers. And finally, we'll put it all together in a simple income playbook for 2026. Okay, so your portfolio yield is in the gutter. The first instinct for a lot of people is pretty simple, right? Just go find stocks that pay more. But this is often a really dangerous path. It's one that leads you straight into what's known as the high-yield mirage, or to put it more bluntly, the yield trap. So what is a yield trap? Well, it's a stock that kind of lures you in with a super juicy dividend. We're talking 8%, 10%, maybe even more. It looks incredible on a spreadsheet. But that high number, it is almost always a massive red flag. It often means the company's in serious trouble and its stock price has been crushed, which, by the way, is what artificially inflates that yield percentage. Usually, the company's about to slash that dividend, and when they do, boom, the stock price just falls off a cliff. Look at this, it's a perfect illustration. On the left, that's your classic yield trap. It's maybe a dying retail company, and yeah, it's offering an 8% yield, but the business is crumbling and the stock is in a nosedive. That yield isn't a reward, it's a warning. Now look at the right. This is what sustainable growth looks like. It's an AI infrastructure company. Sure, the yield's only 2%, but look closer. They're pouring cash back into the business, and the stock is actually going up. Here's the key takeaway. The company on the left is paying you from a pie that's shrinking, while the one on the right is busy making the whole pie bigger for everybody. And hey, don't just take it from me. The godfather of value investing himself, Benjamin Graham, warned us about this exact thing decades ago. For those who don't know, this is the guy who literally taught Warren Buffett how to invest. And this quote just nails his whole philosophy. Safety and the health of the business have to come before a sexy yield. Chasing a big number without looking under the hood, well, it's a recipe for disaster. So if we're not going to chase those dangerous high yields, where do we find real sustainable income? Well, our first pillar is built on the foundation of the single biggest tech shift of our lifetime, artificial intelligence. But, and this is important, we're not talking about chasing the high-flying AI stocks you hear about on the news. We're looking at the boring, physical stuff that makes it all work. Just to get a sense of the scale here, let's start with this number. Global spending on AI is projected to absolutely explode, topping $2 trillion in 2026. This isn't just about clever software anymore. We are talking about a massive, global, industrial-scale build-out. This digital world runs on very real physical infrastructure, and a $2 trillion tidal wave of cash is heading right for it. And all that spending leads us to the single biggest bottleneck in the entire AI universe: power. AI models are unbelievably hungry for energy. To keep up with all the new data centers coming online, energy demand from them is set to jump by 3.5 times by 2030. That is a colossal number, and it means we need a gigantic investment in the real world, specifically in the energy grid that powers, well, everything. Okay, so this right here is the heart of our first big idea. I want you to think of energy infrastructure companies as owning the toll roads for electrons.
Every single AI search, every bit of data, every model being trained, it all has to flow through their grids and pipelines. These companies have incredible pricing power. Sometimes they're even regulated monopolies, which is an amazing hedge against inflation. You can't just decide to build a competing power grid tomorrow. The barriers to entry are massive. And most importantly, there's really no substitute. This all comes together to create a recipe for super stable, growing cash flow that can feed our portfolios.
Okay, let's move on to our second pillar. Now, if the AI play is this big, long-term growth story, our next idea is tailor-made for the world we're living in right now, an economy with higher for longer interest rates. We're going to look at a very specific type of company that basically acts as the market's shadow banks. These companies are called business development companies, or BDCs for short. To put it simply, they're public companies that lend money to private, medium-sized businesses. Think about those solid, established companies that are too big for a local bank loan, but not big enough to sell bonds on the open market. BDCs step in and fill that exact gap, providing crucial funding to companies in everything from software to healthcare. And their business model is beautifully simple. First, they raise money from you and me by selling shares on the stock market. Step 2, they take that cash and lend it out to hundreds of different private companies. And, this part is critical, they do it at floating interest rates. So when the Federal Reserve raises rates, the rates BDCs charge on their loans go up too. And finally, step 3, their special legal structure requires them to pay out at least 90% of their taxable income to us, the shareholders, in the form of dividends. And that structure is what can generate some really attractive yields.
Now, this is always the first question people ask, and it is absolutely the right one. If BDCs do so well when rates are high, won't they get totally smoked when the Fed starts cutting? It's a fair point. And yeah, lower rates would likely squeeze their profit margins a bit. But there are two things to remember here. First, everybody knows rate cuts are probably coming in 2026, so a lot of that is already baked into the stock prices. And second, lower rates actually make it easier for the companies they lend to pay back their loans, which means fewer defaults. That's a big positive. So it's a bit of a balancing act for sure, but those high yields they're paying now give you a pretty nice cushion.
All right, on to our third and final pillar, and this one really brings us full circle. We're going to shift our focus away from companies that are paying big dividends today and instead look for the companies that have the potential to become the dividend giants of tomorrow. You know, it's that old Wayne Gretzky saying, skate to where the puck is going, not where it has been. This quote just perfectly sums up the mindset we need. Investing isn't about what a company made yesterday, it's about what the market thinks it's going to make years down the road. The stock market is always trying to look into the future. And the single most powerful driver of a stock's value over the long haul is the trajectory of its growth.
So how do we apply this? We use the classic picks and shovels strategy for the AI gold rush. Instead of trying to guess which AI company is going to be the big winner, we invest in the companies that are selling the essential tools to all of them. We're talking about the companies that build the crazy cooling systems needed for data centers, the high-speed networking equipment, all that critical behind-the-scenes stuff. Right now, their dividends are tiny because they're plowing every single spare dollar back into growing the business. But as this AI boom plays out, their potential to grow their earnings and eventually become the next great dividend payers is just immense.
Okay, we have covered a ton of ground. We've taken apart the whole high-yield mirage, and we've built up 3 totally separate pillars for finding income in this new environment. So let's put it all together now into a really clear, actionable playbook.
This table breaks it all down perfectly. First up, you've got energy infrastructure. That's the AI toll road play, giving you stable, inflation-protected cash flows. The biggest risk there? Probably new regulations. Second, you have the BDCs, our shadow banks. They give you high yields right now, but you have to keep an eye on the Fed and on credit quality. And third, our AI dividend growth stocks, the picks and shovels. The upside is massive future growth, but the trade-off is a lower yield today and more stock market volatility. These are 3 very different tools for very different jobs in your portfolio. So I'll just leave you with this one last thought. The old playbook, just buying a bunch of blue chip stocks for a 4% yield, it's broken. It's just not going to work anymore. The world has fundamentally changed. So the really crucial question you need to ask yourself is this. Are you investing based on the economy of yesterday, or are you building a portfolio designed to profit from the essential economy of tomorrow? Because honestly, the answer to that question is going to shape your entire financial future.